Okay, this isn't going to happen instantaneously, which means, come back in half an hour. And come back in an hour. The market is not going to develop a weave instantaneously. Again, you don't need to sit in front of the screen for this. So boom, here we go. The market crosses. Now you're thinking, okay, I can see that we've got a big move right here, which means it's going to take a little while for the market to form up. So again, if this thing is going to weave, it's going to take some time. 1, 2, 3, 4. 4 bars. An hour later, boom, look at that. Big difference between this here and this, isn't there? Okay, the market, the moving average rather, has crossed and is starting to come back together. Here, the moving averages cross and move apart. So it crosses. Now we're in a weave. But again, if you're unsure and you're thinking, that just doesn't look like a weave, then don't trade. But what I want to illustrate, here's the example. Okay, so come back, focus again. If you're answering your email or reading a book, whatever, focus back. This is why most of you will have difficulty trading intraday time frames. And if you feel like I'm trying to discourage you from trading intraday, listen, that's based on 10 years of dealing with traders. Okay? I'm not trying to say that you're not capable or that you're somehow not as smart as most people. I'm just telling you that there are some very serious issues for you to consider trading intraday. So here you go. The weave has started. So you've got to decide where you are going to trade. Because we have to wait for the close of a bar, which means we've got to really wait until this bar is closed. There's no way to trade on these two highs at all. So you've got to look back to this high and possibly this low for a hand. I said possibly because it just depends on how aggressive you are. If you wait for the market to get down here, the truth of the matter is you've waited for the market to gain some speed, and you've got a better shot at the market continuing. The mistake that traders make is thinking, I got to get in on the beginning of the move. Well, remember, if you do that, you're trying to say, hey, I know where the professionals are going to move the market. Think about that. We don't know squat about what the professionals are really doing. We can only know in retrospect. In other words, we only know in hindsight. So we've got a hand here and a hand here. So let's take a look at what happens. Boom. Market volatility snaps into a long trade. Very nearly, and in fact most likely would have triggered you in down here. So either way it happened, whether the market traded down first or back up, you got whipsawed. Okay, so one way or the other, if the market went down first, then you got stopped out of one and you're still in a long trade if you had a buy in reverse, or you've been stopped into one trade and right out of the other. And think about this, folks, that happened in one 15-minute time span. The market just said, boom, boom, in and out, gotcha. So as we continue, you can see the weave again develops. So what are we looking at here? We're looking at the market chewing through and deciding on where it's going to trade. We have a hand down here. We have a hand down up there. Continuing on. Boom. Market falls through, triggers the short trade. Now again, if we're focused in on where could we possibly go, I've got to go up to a 4-hour bar, sorry. This is all happening down in this area here. I know it's difficult for you to see, but what I want to illustrate to you is your target for the move